Okay, we have a guest with us. Mayuresh Joshi of Angel Broking has joined in. Mayuresh, now you know all the numbers. Abhishek has read them out to you. Your first thoughts, is the worst in the price?
Afternoon, Lata. Again, I think going by the numbers, yes, disappointing to say the least. But largely, again, the street was making in that the second half, which includes Q3 and Q4, will have higher proportions coming through, both in terms of asset quality pressures coming in. And as Abhishek was mentioning the numbers, I think the trend can very well continue into Q4 as well. So with elevated slippages coming through and recognition happening over and above the previous 60% guidance from the watch list to be going on the higher side, I think that will keep credit costs high and the provisions high as well. So largely, again, I think soft set of numbers were expected. Little disappointed with what has come through in terms of the NII growth as well. But again, I think Q3, Q4 were expected to be soft, and a large part of recognition will probably come through in these two quarters as well.
Mayuresh, taking on the point that Lata was making earlier, how would you expect the stock to react tomorrow?
Going by the numbers, and again, I think one really needs to hear what the management has to say in terms of how the book is expected to pan out, and the large part in terms of how the entire credit scenario is looking for the banking sector as a whole. My own sense is that a soft start can be expected for the bank. But again, I think any positive statements in terms of improvement in asset quality going ahead after the large recognition would probably be done in Q3, Q4. I think too early to say that at this point of time. But again, I think if there are any hints in that direction, I think that would be positive. But no, I think expecting a soft start for the bank in tomorrow's day.
Despite the fact, Mayuresh, that, slippages have come off nearly half on a quarter-on-quarter basis, provisions or credit cost is still elevated. So would you rework on your numbers in terms of estimating for Q4 and thereby taking an impact on FY17?
So largely, Abhishek, as I was mentioning earlier, I think we, going by management commentary for Q3, Q4, we have built into our sheets higher credit costs for the bank for the remainder part of FY17, which is Q3, Q4. And again, I think with the higher proportion of slippages continuing, credit costs are expected to stay high. Again, I think one really needs to understand on the non-interest income part. So I think to a certain extent, I think compensation might actually come through from trading gains for the bank. What proportion that gets offsetted, one really needs to see. But yes, we're still building in higher credit for FY17. And that would start probably coming down gradually over FY18 as growth picks up, as asset quality pressures start diminishing in a gradual way. But largely, again, I think because of elevated credit costs, I think the return ratios will also remain.
Not only there is, Mayuresh, not only there is elevated credit costs, but there is also a decline in your net interest income. So your core earnings is actually weak. And if you see this quarter, there has been a spike in yields and therefore, some sort of treasury gains. They don't have subsidiaries like ICICI or others, wherein they can encash the value opportunity. So really, do you fear in terms of core earnings over the next 1 or 2 quarters to remain weak and therefore earnings to be under pressure?
Oh yes, largely as I said, for FY17, I think disappointed with the NII growth that the bank has given in Q3. But largely, I think what has been the case, whether it was demonetization or whether it was cash collections and recoveries and upgradations that probably gave way to the NII growth in a soft and tepid manner, one really has to see. Secondly, again, I think in terms of the granular structure on the non-interest income part, I think the retail, SME and transaction banking still form a substantial chunk. Retail still forms a substantial chunk, almost 43-45% to the fee income. So how they're able to build on that is something to be seen. But largely operationally, yes, I think soft and weak numbers coming through, and still expecting soft numbers to come through for Q4, both in terms of how the credit growth will pan out and the operational performance in terms of recognition of the budget.
A quick word with Himendra Hazari, who's just joining in on the call. Himendra, what do you make of the numbers and what would you expect in terms of management commentary? What are the points that you're looking out for?
What can you expect from management when they report such results? Where a lot of their people have been arrested in this recent demonetization fiasco. They seem to be clueless what is going on, and a lot of it really has to be done with their own conduct. So in such a situation, there's not much that you can expect. Now you have to just live through this pain. This pain, in my opinion, should have been done about 2 years ago, but it has got deferred to this moment.
Yep.
So this was to be expected, and this now one the shareholder has to live through it. That's about it.
Okay, Himendra, point taken. This should have been taken earlier, and perhaps that's what the Reserve Bank's asset quality review was all about, that people are not taking the pain when they should, and hence just forcing them to recognize some top 100 accounts or 150 accounts as NPAs. We are seeing the results now, and now with the steel cycle hopefully turning, interest rates falling, maybe the pace of generation of fresh NPLs across the banking system will be lesser. Maybe the poison is out of the system. What do you think, Prakash? Does it look like all the bad news, or at least 95% of the bad news, is out? Will anyone venture to catch this falling knife, buy the stock now?
I don't think so, Lata. See, this is a corporate-facing bank, and till the capex cycle brings in some hopes and respite, there's no way the NPA cycle is bottoming out. So very clearly, last quarter also we thought, the kitchen sinking could have probably indicated some this thing, and the demonetization has just probably delayed the whole process. So I would give it 2 more quarters before anything of that sort happens. And there are much better stocks on the corporate-facing side that people would want to buy into. I don't think Axis cuts that makes that great.
Prakash, would you prepare? What would you prepare for as far as stock reaction is concerned tomorrow?
Yeah, so I think the stock anyways was under pressure, and it hasn't participated in this up move recent weeks that we saw some of the other banks do. So I would believe it would continue slipping sideways, lose interest, people will lose interest. But there's no dramatic cut or something that would happen tomorrow.
Okay.
It was expected
Mayuresh,
to be, expected to be one of the stronger banks, until 6 months back or 9 months back, and the results have actually disappointed over the last 2 or 3 quarters once they have started releasing the watch list. So Prakash, by when do you see comfort coming back in terms of investors' confidence returning to Axis Bank?
Okay, Mayuresh, is there any point at which you will buy the stock? What are your thoughts now for those who are already invested or who would want to invest?
No, again, Lata, the pain will continue, as I said, for at least 1 more quarter. And again, going forward, how the trajectory pans out in terms of credit growth. And as you're rightly pointing out, I think with some relief coming through, at least from the metal space, there would be some amount of respite for a lot of these corporate-facing banks for industries like metals and mining. But largely beyond that, my entire sense is that the sideways move, as Prakash was mentioning, might very well continue for corporate-facing banks like Axis and ICICI. And again, largely it will be something for the management to probably persevere over the next few quarters in terms of how their growth will pan out, specifically on the retail side, which have been the key focus for a lot of these corporate-facing banks.
Well, retail... Sorry, I was just going to say retail advances account for 43% of net advances. So clearly the bank is making advances in terms of its retail corporate split. It was 40%, I think, when they last reported, and they have steadily crawled up to 43%. Fee income constitutes, retail fee income again constitutes about 45% of the total fee income. So they are getting less dependent on corporates. And, we are getting all-round sales from everyone, Prakash, Mayuresh, Himendra, all of them, and it is precisely when the mood is so bleak that stocks typically bottom out. There are a couple of things going for the Indian banking sector. They have been forced by the regulator and by force of circumstances to recognize a lot of the pain. Interest rates are falling, which always makes the next bad loan perhaps less likely, because of falling interest rates, the ability to come back. As well, we are seeing an unusual resilience in metal prices.